Welcome back, everybody. With all the information out there about interest rates and how focused on interest rates the market is, there's also a lot of myths out there about interest rates. So we're going to continue our myth busting episodes here about real estate myths. And specifically today, it's a lending myth, the myth that you should always choose the lowest interest rate, or you should always choose the lender offering the lowest interest rate. We're going to go through both of those today and show you why it's not always wise to choose the lowest rate, and why the rates that a lot of these lenders are advertising to you aren't actually real rates that you can get in the real world anyway. As always, I'm your host of the Informed Homebuyer Podcast, Rich Curtis, and I have my co-host with me, Dave Miller. Morning, Dave.
Good morning, Rich. Thanks for having me. Looking forward to this one.
All right, Dave. So this is right in your wheelhouse. We're dealing with lending myths. So break down for people the way rates work, the cost to get different rates, why the lowest rate isn't always the most advantageous, and kind of walk us through some of the math on that.
Yeah, good point, Rich. And so, when folks are shopping for interest rates, there's a lot of criteria. And we always talk about it on this podcast. When we talk about average rates, a lot of criteria go into being able to quote an interest rate, things that are important for lenders to know or to make the determination of an interest rate is going to be credit score. It's going to be amount of down payment. It's going to be debt to income ratio, loan program, term of the loan. There's a lot of criteria. Loan to value is, so there's just so many different things that are important to get an accurate interest rate. And so when you see an advertisement for an interest rate, you're going to see a rate, and we're required to also publish APR. And so there's going to be a big delta between what the interest rate is and what the APR is if somebody's charging. So what lenders like to do is they like to quote an interest rate that assumes the best of all scenarios, the best credit score, the best income, what we call a full documentation loan, probably oftentimes at least 40% down. So not necessarily real world scenario. That's kind of like the best case scenario. And then at the same time, they'll be in the fine print or a small APR, or this includes points or a cost to buy down that loan. And, a lot of people, and this has gone, historically, is points are bad. Points are terrible. I don't want to pay any points. I still have people say, I want the best interest rate without points. Well, there's sometimes where it makes sense to pay a point or a percentage of a point, and it's not always a full point. So what we call in the business, what we call the par rate is really the interest rate without you paying any points to lower that rate, or without getting a lender credit for taking a higher rate. So that's the other part that comes into the equation, is sometimes you could take a higher rate, and people say, well, why would that make sense? Well, and it always changes, and it's changed historically with time. You might be able to take an 8% higher interest rate, which would change your payment $30 a month, but maybe get a full point credit of $3,000. Well, that might make sense, especially if you're in a situation where you don't have a lot of cash. So there's, different aspects to buying down your interest rate or taking a credit for that interest rate. And we need to talk through that. And that changes daily. The credit or cost to get a rate.
And let's give them the 30,000 foot view when we're talking. So Dave's talking about a par rate. That means no credit to you, no payment for you. You get that rate at no cost, right?
Now, and when we talk about no cost, there's still escrow, title, and lender fees.
Yes, really good point. There's still lots of costs, just no cost to move the rate around.
That is correct. No, yes.
Important distinction, Dave. Yes.
Yeah. So you're always going to pay, and let's just say a lender fee, for us, maybe it's $12.95, and that's it. And you get the, fair market rate or the par rate. But if you want to buy that down, you still pay the, the processing and underwriting fee, but then that's it. But then if you want to buy down the rate, you pay a point or percentage of points to buy down that rate. So good distinction there.
Yeah. And so when we say a point, explain what that means. What is a point? A point of what?
A point of the loan amount. So it's typically done in 1/8 increments, 0.125 or 1/8. And we use, on this podcast, we always use a $500,000 purchase as kind of our go-to. And if you were to put, 100,000 down, and you're going to have a $400,000 loan. And if you pay a point, it's 1% of that 400,000, which is $4,000. Um,
Gotcha.
yes.
And historically, what's let's use some rates. So we're not quoting real rates, so people aren't attached.
Yes.
Let's use a rate that is not available today. If par was 5%, please nobody quote par is
Yeah.
not 5%. We don't have
Right.
5% rates. This is a
Yeah.
hypothetical so that we're not quoting actual rates or confusing people. So for
Yeah.
the hypothetical, if par is 5%, what would paying 1 point get you usually in a reduced rate?
In a reduced rate, and that's good. And it's not always linear, meaning you can pay, let's just say a quarter point might take you down. And just for simplicity, I say we use 6%. That's more in line with where we're at today.
Okay.
So if you say 6% and it's going to vary daily, and I might pay, and sometimes I encourage this, I might pay a quarter point, which would be, of that $400,000 loan, that would be $1,000.
Yep.
Quarter point might buy you down an eighth. And at that point, it's going to save you about $40 a month, 35 to $40 a month. And so if you do the math in 12 months, you're look $500. So in 2 years, you're going to recapture that cost to buy down the loan. Now, going from, and it's not always, I can't just pay an eighth per quarter to go down another eighth in interest rate. So to go from 6 to 5.75 might cost a full point. And that might be, $4,000, where I would always say, no, don't pay that money down. Don't buy that rate. And I've had engineers and people that are super smart say, well, if I pay that now over 30 years, I'm going to save, $27,000, or, I'm just making up that number over the life of the loan. But the reality is you're probably not, this loan, less than probably 5% of the time will make it to term.
Yeah,
So
right. So, and we're talking about 30-year fix, and we'll talk a little bit more about some of the games that lenders play in their advertising like 15-year rates and not making that very clear. But
yeah,
we're talking about 30-year loan here. So the historical average is around 5 to 7. Every 5 to 7 years, people sell or refinance, and
that
it's
is correct.
stretched out. Yeah, it's stretched out to closer to like 10 now because that lock-in effect, because the COVID era rates, people not wanting to give those up. But even over the 10 years, when that guy's saying, I'm going to save 30 grand over this 30-year loan on interest, no, you're not, because you're not going to keep most of you are not going to keep unless you're that guy, you're going to lock in this loan. You're never moving.
Yeah,
You're never refinancing, fine. But that is, 1%
yeah,
of the people we work with. Everybody else is going to do this every 5 to 10 years.
right. And I encourage people, and you also have to think about the value of the dollar today pre-inflation. So you're going to pay that now, and that's money out of your pocket now to buy down that rate. And it's not necessary, and that's why I would say the recapture rate, or the time to break even, which we just decide, I look at what the payment differential is per buy down, and how long does that take to make up what that cost was. And so that scenario we gave you, it took you about, less than 2 years. That might make sense. But if you buy down your rate, and let's just say a year from now, interest rates drop a full point, and you have an opportunity to refinance, anything you paid to buy down that rate is basically lost. Well, you would still save $800, if you did it in a year, at $40, or excuse me, $500 roughly. If you saved $40 a month and you did it in a year, you still made the benefit of $480, but the balance you would have lost. And so it
Yeah.
probably doesn't make sense.
But you paid 1,000 to save 500, and now the rates drop, and you're going to refinance again. And oh, by the way, you're going to pay an additional set of fees. Even if you choose not to buy the rate down, you're still going to pay all those other refinance
Yeah.
fees. Which, and maybe that's another section we'll get into later, is the
Yeah.
fact that there's not really a no cost refi option.
Right.
They-
Well, I think
there's
that's,
always
yeah.
fees.
And yeah, there's not a no cost refi option. Truly, you do the cost and rate, but that's really a good point to bring up, because the difference between a refinance and a purchase, when we refinance, you can use the equity in the property, and use that sometimes to pay the fees to buy down the rate. And what I find a lot of people do is they hedge. And what I mean by that is, if rates are trending down, so give you an example, if someone bought a house a year ago and their rate was 7%, right? A lot of people are coming to me now and saying, hey, I bought my house at X interest rate. I think it might be time to refinance. And I'm saying, hey, let's pump the brakes. because I think there's more likelihood if we wait another month or two that you're going to get a better interest rate than you will today. Obviously, no guarantee, but there's also the opportunity to refinance, let the lender, so if you were at 7, you can refinance to 6.5 and take that lender credit to offset the fee. So it didn't really cost you anything to refinance. But the thing that you're doing when you refinance, and we'll talk about this on a purchase as well, is you're extending the life of the loan. And so, if you do a 30-year today, or, a year ago, and then you refinance today, you just extended the life of your loan by a year, which most people don't care, because the difference of 29, 30, 31 years down the road isn't going to impact them. You're doing what makes sense for your economic, situation today.
Yeah, and I think this gets a little muddy and in the weeds. So let's kind of go through this. So one of the reasons not to choose the lowest interest rate is because there's often a cost to it. So the par rate is often not the lowest interest rate. Is that fair to say? The lowest
That is
available.
that is fair to say. And yeah,
And so the
you bring
lowest available has a cost to it.
that is correct. And so when you see advertisements and the lowest available rate, they also sometimes don't take into consideration the things that I talked about: your credit score, the debt to
Yep.
income ratio, the loan to value. But also, you'll see in the fine print that might be a 30-year mortgage, but only fixed for 5 years, or 7 year. It's an ARM mortgage, and it's misleading because it's still amortized over 30 years. It just adjusts after a fixed period of time. And there was a
Yeah.
point in time when I started in this business, and it was pretty common, because rates didn't tend to spike or come down. It was pretty common to take a 5, 7, or a 10-year ARM, because that rate was often a full point lower than the 30-year with no additional cost.
And it was worth
So
the risk at the time because it wasn't very, but a lot of people got caught out on that in the Great Recession.
yes, that is correct. And so once rates adjusted, and some people, and I even experienced it, I'm a big proponent of a 30-year fixed mortgage and not having to worry about it. There was a
Yeah.
point in time on an investment property, where I did an ARM loan, and it readjusted 7 years later, and my rate actually dropped,
Yeah.
which is
Yeah.
very rare. And the likelihood of that happening is pretty small. And because we were, in the financial crisis that caused all kinds of chaos, and the interest rates were actually lower when that loan adjusted. Um,
Yeah. But so when you're thinking about rate, you're thinking about, okay, I want the lowest possible rate. And you talk to your lender, and yeah, you can have the lowest possible rate, but it's going to have this cost to it. And when you have this cost, you want to go through the math and have a lender who can have a nuanced conversation with you, go through the math that you were talking about on that recapture rate. Well, based on what
yes.
you're saving, how long until you're positive? And so what's your kind of mental math? I have my own on this, but what's your, like, this recapture rate is too long. Like, if it's going to take me this long to recapture, it's not worth paying the money to get to the lowest rate, because it's just not going to work out. It's likely I will refi, or rates will move around to the point where I want to do something different. I'm going to incur a second set of fees if I leave that much time on the table. So
Right.
what's your kind of sweet spot recapture rate on buying down rates?
For me, Rich, it's 3 years. If it's under 3 years, and it also kind of, I look at the environment we're in, right? Like, right now, if that conversation, a year ago might have been a little bit different than it is today, but as a rule, it's right around 3 years. Because typically when you purchase a home or you refinance, you got to wait 6 months. Even there's not a true hard prepay penalty. Some loans you have to wait a certain amount of time. We'll get into that. VA loans and FHA loans. There's different loans, and there's some type of time limits to be able to refinance. Um, but usually most folks, if you wait under 3 years, and maybe you had that loan for a year, you already ate up a third of that. So or you've used a third of it. So maybe you eat, 2 years cost of payment. Um, but yeah, I think that's typically, and part of that equation too is, depending on how much money you put down, is, if you're just putting 5% down or 3% down, you're probably going to have to wait a fair amount of time to use that equity in your home to refinance. You're going to need time to build equity. If you're
Well, and the
putting
cost of the points is going to be higher because you put less down, so your loan value is higher. So the math shifts on your recapture rate in that scenario too.
That, yep, that is a good point. And so, if you're for someone that's buying a house with 5% down, and maybe they want to wait to refinance and get rid of mortgage insurance. Well, the likelihood of that is probably going to be just based on, we'll just say, 3% appreciation. In 5 years, you've appreciated 15%, you put 5% down, you're probably looking at that minimum amount of time till you could refinance and avoid mortgage insurance.
Yeah.
So every scenario is a little bit different, but if you're putting more than 20% down, 25, 30, 40% down, that's even makes the recapture time less, right? Like, don't pay
Yeah.
that down now, because there's a good likelihood, based on your scenario, there's already built-in equity. Even if values drop a little bit, you'll still be in a position where you could refinance and take advantage of lower interest rates when they come.
Yeah, and this is a good place to sort of look at the different ways people approach these things, because my recapture rate tolerance is lower than yours. And again, there's no hard and fast rules in this, guys. Some of this is just how you approach your money and how you think about things, and how long you've been on this planet, and how many cycles you've watched work out, and what your confidence is in the next cycle. I usually shoot for 2 years or less on my recapture rate, but I'm very conservative, at least from a safe harbor perspective on my money. I'm a little more, I want that. And in your previous scenario of a $500,000 loan with 20% down, 100 grand, a quarter point to buy the rate down at $1,000, and you get 480 every 12 months, savings out of that. Well, that's right at my 2 year, recapture rate. So that kind of
Yeah.
fits in that box for me. So you don't have to take Dave and I's exact rules. The point here is to do the math. If you're working with a lender that's just like, hey, I can get you this best rate, here's the rate, let's do this, and they're not explaining to you, and they legally have to explain to you, it's on all the documents, right? But it's very easy to get confused. The disclosure statements are very confusing. So if you don't have someone that's telling you, oh, by the way, to get that best rate, you're actually paying $1,000, and oh, by the way, look at the what the Fed's saying and what's going on in the market right now, I think interest rates might march down, and you might be looking at a refi opportunity in the next 1 to 2 years. Let's play this out. Let's do the math. Does it really make sense to get you that best rate, or should you be an eighth higher, but you didn't have to pay for it, or should you be a little bit higher than that and actually get a lender credit, because what you actually need is a little bit more money in your pocket to pay closing costs because you're having affordability issues. These are the kind of nuanced conversations that Dave is great at having, both in person and on the podcast, that adds a lot of value and saves you a lot of money from a lot of lending mistakes.
Yeah, and you bring up really good points, Rich. The other thing that you'll notice is, and I think there's a psychological aspect to it for a lot of folks. And we use the 6% rate, right? If it was an eighth or an eighth of a point cost to buy it down from 6 to 5.875, a lot of people are going to forego their rule about a recapture, because you know what, they want to tell their, the next Christmas dinner, well, I got a 5.875 rate. Sounds way
Yeah.
better, because people sit around, oh, you just bought a new house, that's great, what kind of rate did you get? I know rates are high. Oh, 5.875 sounds way better than 6%. Or even part of that conversation, and this has always happened, is your aunt, uncle, or someone's going to say, oh, well, you could have got a better rate. Well, yeah, I could have paid a bunch of money to get that rate, or you used your equity to buy down your rate, and this is the last time you're going to do that. So it's not apples, it's apples and oranges when you're
Yeah.
having those conversations.
Well, there's this great guy, Morgan Housel. He wrote, I think, one of the best books on money ever written, called The Psychology of Money. And he points out that your financial decisions don't have to be logical. They just have to be rational for you. So you and I might make completely different financial decisions based on our own sort of filters and matrix. As long as they're rational for you, that makes sense. So no judgment. If you want to spend that money, even if it doesn't make sense, so you get to say at the housewarming party that you got a 5% rate, knock yourself out. It's just Dave and I's job to make sure you did that with open eyes. It's
Yes.
our job to give you good advice once and say, hey, just so you know, this might not pencil. And then you get to say, I don't care what you said. I want to do what I want to do.
Yeah, and you bring up a really good point. It's my job to lay all these options out and say, okay, and go as far as you want to go as a consumer. If the rate's 6%, and someone will say, well, what's it going to cost me to get a rate of 5.5% because I really want it? I will tell you what it costs. I will simultaneously tell you, I don't think it makes sense to do that, but I don't pay the bills. It's your decision. Here's the cost. Here's the reasons why I don't think it makes sense. And at the end of the day, you make that decision as the consumer. But oftentimes when I spell this out and there's some logic involved, people start to say, the other thing that is really important to know is it's not a major life decision when we're talking about buying down your rate by an eighth percent or taking an eighth quarter. And I can't tell you how many folks I'm having a conversation with. They're like, oh my gosh, I don't know what to do. What do you think I should do? Once you I'll give you the numbers, and like we talk about that recapture, whatever you decide, if it's a 2-year or 3-year, it's not going to be life altering money. It's not this overwhelming decision that you just have to be kept up, over, several nights, like, oh shoot, what do I do? What do I do? We have a conversation. It's really, making the best decision with the information you have.
Well, it's such a good point, and it's so funny. The things that we get focused on are often not the most important elements. And this is not throwing shade. Dave and I are human creatures just like you. We have our own set of emotions about these decisions. And we have frankly made our own set of mistakes over the years with these decisions, which we sort of bring to the table to try to help you guys avoid those. But when we look at this, type of thing, the 5 real estate fundamentals that, if you watch podcasts all the time, you're probably like, would you shut up about this? We talk about this all the time. But
Yeah.
but those things are so much more important. Like focusing on having an emergency fund will change your life. An eighth of a percentage point won't change your life, right? Like the mental and emotional freeboard that you get and security you get out of knowing that if I lose my job, I can pay my mortgage and keep food on the table for the next 6 months. That's a huge, choice. Not $30 a month on your mortgage payment. Having good credit, which affects you in literally everything you try to do, in your life, having, stable employment that you feel good about, having, a down payment saved up. These things are going to move the needle so much more. But nobody wants to focus on those things. It's just interest rate because you're just bombarded with it in the news all the time. And it's, I think I was telling you, we're doing this remodel on my dad's house who passed away. And my brother had called me about $1,000, we got to fix some pipes for $1,000. And it was like a less than 1% decision compared to the price of the house. And I was like, I hung up the phone. I'm like, oh, should we do this? And all of a sudden I was like, wait, that's a less than one. What am I doing? Yes. Fix the dang pipes.
Yeah.
It's,
Right.
we get so focused on these things that aren't really going to move the needle. It's important to pay attention and listen when someone like Dave says, this is a $30 a month decision. So don't really, lose sleep over this one,
Yeah, and the other thing too is you have that loan, say you'll have a loan for 5 years. The likelihood, and for most of you that are purchasing a home or depend on your scenario, your income's going to go up over time, and your next raise is probably going to be more than $30 a month. Um,
Right.
so it really puts it into perspective. And for some folks, and first time home buyers, every dollar got to buy diapers, $30. I don't ever want to discount the value of $30 to someone, but in 2 years, 3 years, 5 years, that's probably not going to matter.
Yeah.
Especially with what things cost today, and with income amounts and typical cost or inflationary raises that people get. Because the one thing you got to remember is that mortgage is fixed. That principal and interest is fixed. It's not going to change, but there's a much higher probability that your income is going to go up, and even go up with inflation. So if you get a 3.5 or between 2 and 6% increase in your income, that $30 is going to be like pennies to you.
Yeah, and the point we're making here isn't, wave a hand. These are not the numbers you want to see here. Like, we're not saying don't pay attention to the numbers, don't get granular. Certainly do that. What we're saying is don't twist yourself into knots over 1% decisions, right? Don't, because there's so much emotion involved in buying a house, and there's so many big decisions. There's so much to get tangled up over. Just be aware of which decisions make a bigger impact on your life and which don't. It is important to be granular about it. It's important to pay attention to the numbers and go in clear-eyed. Just don't twist yourself into knots about it.
Right. And I think the other thing I want to bring up here is when folks, and there's a difference, and there'll be a separate podcast, either pre-qualified or pre-approved. There's different, meanings between, and then formally approved. When you are shopping for a home, or you're thinking about shopping a home, and I produce a pre-approval letter for a consumer, that's going to have an interest rate on there, but that's going to have an interest rate that is much higher than fair market rate. And and I've oftentimes produced that, and sometimes the buyers don't even see the pre-approval letter. It goes to the agent, and the agent sends it to the listing agent. But that rate oftentimes is going to be a 0.5% or more higher than the fair market rate. And that's because markets change, and the seller and the listing agent want to know, hey, if interest rates go up 1/4 point in the next 30 days, does that consumer still qualify for the loan? And that's all we're trying to accomplish at that point. We're saying you don't because not everyone has the ability to buy down a rate. And if I issue a pre-approval letter with, that's equal to a full point buy down and the rates, way better than fair market rate, that's a little concerning for a listing agent and seller, because that's not necessarily the fair market rate, without, the hidden fees and whatnot.
Well, I think that's a great segue, and I'll throw a slide up here into doing a little consumer education into ways things are presented. So there's ways things can be presented that are just confusing, and unfortunately, some of the confusing ways we present things are just the way we're legally bound to. So way back in the day, Dave and I have been in this business long enough. We used to be able to produce a very basic net sheet, like a zero sum. Costs on this side, credits on this side, the math, all maths by the bottom. Anybody can understand this, and then for some reason, the government thought that wasn't transparent enough, and they wanted the consumer to have a better thing. And they made Dave's industry, the lenders, do this closing disclosure, which is massively confusing in the way it's presented, but not intentionally so. That's just legally. But there are other ways in advertisement that things can be presented sort of disingenuously. And so I'm going to put a slide up and we can talk about that. But you look like you have a point to make while I'm putting the slide up.
Oh, yeah. I was just saying, it's usually when you go from, 1 pages to 3 pages and a lot more information, that's not usually more clear and concise for the consumer. But what that was really designed to do was to present some information, but to hold unscrupulous lenders accountable and make sure they're providing all the necessary information, because they would leave some information out. And I've seen things, and again, I've seen, lenders quote, well, here's your payment. Well, sounds amazing to the buyer, but maybe it didn't include taxes, insurance. So all of a sudden, there's a $700 increased payment or more, because the lender just quoted you a payment and you thought that was so much better, but they didn't disclose that also includes taxes and insurance.
Yeah. 100%. And that closing disclosure did some things good that weren't being done, and it held some people to account so that they couldn't pull any shifty business. At the same time, sort of befuddled the average consumer, because it's just so many line items to go through. But that is an example of something that is not disingenuous, but potentially confusing. But sometimes advertisements can be a little disingenuous, and we want to help you kind of pick the signal from the noise. So and I get these all the time from lenders in my email, these sort of rate sheets, right? And if you've been watching the pod for a while, we can't quote exact rates because of all the things Dave talked about, credit score, yada, yada, right? But people will quote these rates under these really sort of constrained fine print scenarios, so you'll see, and this one at least is saying it's a 30-year, and so you have a 6.19 in the top left corner for 30-year, and you have a 5.4 in the bottom right. And at least on that, in the smaller print, it says 15-year. Most people are going to pick that up. But here's the fine print that you might not be able to see on your screen. These rates are the national average per company X, which we're not going to call anybody out here. These included rates with and without discount points are, for example, purposes only, will vary based on the risk features and may not be indicative of X company's rates. Contact me today for a true rate quote. But that's in the very small print that nobody's looking at. And the important thing there are with and without discount points. So some of these rates, you may have talked to Dave on the phone and he told you were going to get 6.25 for a 30-year conforming rate. Then someone emails you this 6.190, and that rate actually takes a point to get to, or a couple of points to get to, and you're not comparing apples to apples. So in Dave's business all the time, people will call and be like, hey man, what are you doing? You're not giving me the best rate. And it's like, well, sure, I can give you the best rate, but I have to charge you for it. So something like this, Dave, if that was a rate with a point, again, we're talking about, on that $400,000 loan, what are people paying possibly for the with or without points, rates that are being advertised here?
Yeah, I mean, in that scenario, if you're paying a full point, you're looking at, like we in our example, $4,000 to buy that down, and that's where that big recapture conversation comes in, and it's really important. And once I start explaining that, the light bulb goes on, and you'll be amazed. And there's also people that come to me, and the first thing, all right, what's your interest rate? And I don't want to pay points. Well, sometimes it just makes sense to pay points because it's not always a full point. It could be and it's interesting if I were, and I'm not prepared to do this, but if I were to show a rate sheet today and today's pricing, when I go in, I could show, and I'll just use an example. If 6% today was the par rate, 5.875 cost you an eighth of a point. 5.75 might cost you a full point, right? But then to go to 5.625, that'll only cost you like a half. It's kind of bizarre the way the pricing works. And it's not, like I said, it's not always linear. And also go in the other direction where you take an eighth higher rate, you might only get an eighth credit, but then you take a quarter higher rate, you might get a full point credit. So big jumps either direction. So, and that's why we wait till you're in contract and we identify. Then when we're ready to lock in, we decide, okay, what is the best rate and the cost to buy that down. And the other last piece on that is sometimes it seems like an overwhelming decision. And I explain to people, hey, we're going to lock in your rate based on this date and time. If you come back to me a week later and say, I really wish I had bought that down, we can do that, or paid a little point or took a lender credit. We can make that adjustment based on the date and time we locked in your loan. So it doesn't have to be something that keeps you up at night. Oh my gosh, did I make the wrong decision? We got a little bit of time to make adjustments.
Yeah, that's a really good point. Like an average escrow is a 30-day time period. You've got some time in that window in which you can change your mind there.
Yes.
Yeah. Well, I think too, when it comes to looking at points and what's presented, what we just put on the screen, it's a good sort of consumer information piece to say, read the fine print. But if you don't want to read the fine print and you have trouble working your way through this, one of the questions we get a lot in the comments: how do you pick a realtor? How do you pick a lender? And you can watch a 40-minute video on this, and we probably should do a whole podcast episode on this, but real easy. How do you pick a realtor? Call them up and ask them, is now a good time to buy or sell? And if they say, yep, it's a great time to buy or sell, give me your information, hang up. You got the wrong guy or girl, right? They should be saying, I don't know, let's talk. What are you trying to do? What's your time frame involved? What's your employment? Why are you making a move? What are your expectations of the house you're going to buy? Is that house even available at the price you think it is, right? Because it often isn't. There's a whole list of questions I got to ask you to determine whether now is a good time to buy or sell. Same on the lender side, if you ask the lender that question, and same with these kinds of conversations. If you're not getting a nuanced conversation, if you call the lender and say, I don't want to pay points, from a sales perspective, it's the easiest thing to do is say, fine, no points. We'll do the par rate and end the conversation, right? But a professional that's actually adding value would say, you might not want to pay points, but let me tell you what's available if you do, and let's do the math, right? So these kind of nuanced conversations you're getting from Dave, that's how you pick a good lender. And you don't have to read the fine print if you pick a good lender. So it's easier, frankly, to call up a lender and ask them this question. Hey, right now, what are the rates? And what's the benefit to me if I buy the rate down? Are there credits available to me if I go with a higher rate? Walk me through it. And if they can do a really good job of that and they're willing to do that, you've got the right, guy or girl on the phone. And if they don't, hang up and call somebody else. I mean, if you throw a stone in your town, you'll hit a realtor and a lender. There's no reason to work with people who can't give good information. So you can watch 40-minute video on how to pick a realtor or lender, but really you can tell when someone's giving you good nuanced information when they're not. And if they're not, then bounce.
Yeah, and I think another point, Rich, is and you worked with a lot of lenders over the years, and sometimes you worked with sellers, and you got buyers that are coming in and they've found their own lender from who knows where, and it can be really challenging. And again, I'm not patting myself on the back here. I've been doing this for 20 plus years. I bought and sold a lot of houses. I know what it's like to be the buyer. I know what it's like to be the seller. I know what it's like to look at a pre-approval letter, but I also know what it's like as a seller to have a conversation with the buyer's lender and know that, hey, this person knows what they're doing. I'm going to ask them a few questions. And as a lender, I'm full service. I'm going to reach out. If you're placing an offer to purchase, I'm going to reach out to that listing agent and not just have a conversation, a very educated conversation, know what's important to them and what's important for that listing agent to convey to their seller, especially in a competitive situation. And even if it's not a competitive situation and you're the only offer, they want to know that they're willing to, tie this house up, put it in escrow, and that they're going to be able to, this buyer's going to be able to perform. And reasons why your offer was written the way it was. You decided to only put 10% down. And you have plenty of cash maybe, and you have enough to put 20 or 30% down, but you plan on remodeling the house, or you got other plans with that money, but you easily qualify, and there's some extra monies there should the house not appraise or whatever might happen, that you're still, as the buyer, you're motivated to get this house.
Yeah, we've worked with some really high net worth individuals that slide an offer across the table that makes them look broke as a joke, right? Makes it like they're putting no money down, they're using an FHA loan, but these are nuanced people who understood the benefits of that FHA loan. They had a plan to refi or get rid of mortgage insurance later, and they liked the benefits of that loan. They were deploying their capital elsewhere because they can get a better delta by putting less on the mortgage and putting more in the markets or more into their business, or they're doing big capital acquisitions this year in their business, so they need to deploy that capital elsewhere. But these are people of means, so you send an offer across the table that could look scary to a seller, like, oh, this person might wash out of the deal because they're just on the razor's edge of affordability, and then they get a call from Dave that tells them that story, explains what's actually going on, and then they're like, oh, okay, this is a strategic move, not a desperation move, in why this offer is structured the way it is.
Yeah, and you make up a good point, Rich, and it might be a good segue into maybe our next podcast of, using the mortgage as a tool. Do we want to pay down our mortgage? How quickly do we want to pay it down? Do we want to pay it off early? And if you really
Yeah.
think about it as that mortgage instrument as a tool, we could talk through that, and, some pros and cons and some things that most people end up doing, and how they leverage their mortgage to generate potentially more wealth, to buy additional real estate, to use the extra monies for remodeling, for college funds. There's all kinds of things that you can do, and leverage your mortgage for, in lieu of just saying, I'm going to get a 30-year mortgage today and I plan on paying it off in 30 years and that's it. Like, that may not make the most sense.
Well, maybe we'll tackle that one next time, guys. Tell us in the comments down below. Do you want to see the real estate myth of you should always pay off your house as quick as you can, or pay it off early next time? If you'd like us to tackle that one and give you a more nuanced take on the different ways you can leverage a mortgage for a better life and better finances, we can do that one for you guys next week. For now, you guys have made it 36 minutes listening to two middle-aged dudes prattle on about loans. You are either a glutton for punishment or you're a rock star dedicated to your own financial education. I hope this one helped. I hope it made you a better, more informed consumer and gave you some things to think about. The lowest rate is not always the best financial choice, and the lender peddling the ultra low, too good to be true rates is not always the best choice either. Hope this gives you some ways to evaluate that. As always, thanks for watching. I'm Rich Curtis.
And I'm Dave Miller. And Rich, I feel like when we're in our 60s, you're still going to be calling us middle-aged dudes. So I'm going to just take what I get here. So
I'm not moving on from that one, right? Like,
no,
I'm not happy about being like middle-aged. I'm not going
we got
to the
a
next level.
lot of runway of being middle-aged. So yeah, I appreciate it.
They just keep pushing it out.
Yeah.
All right. Have a great day, everyone.
All right. Thanks, Rich.